Hello guys. In this recording, I'm just gonna cover. Um, I'm just gonna do basically um, the I'm just gonna do IS 12. So IS 12. That's deferred tax. So deferred. Okay, let me just say. So it's deferred tax. I'm gonna do deferred tax. IS 12 deferred tax. So I'm just gonna give you an easy way to do deferred tax, ne, or how to approach or think of deferred tax. Now, um, this method that I'm gonna use here, ne, I suggest you do not like really write on your paper because that's not how you are taught originally, ne. And I will explain why, like as I go through. So before I start with that, I just want to explain what deferred tax is because I think many people like don't really get what deferred tax is. I think, and that's mainly because they don't know why they do deferred tax in the first place. So let me just show you the reason why you do deferred tax and basically from a real world application point of view, right? So what happens, ne, is that this is what happens in companies. We have accountants, right? And then these accountants, they also know the tax rules that are applicable within that country, right? So the first thing they're going to do is calculate the current tax. That's what they do. The first thing is going to calculate the current tax. And after they calculate the current tax, what they're going to do is they're going to say income tax from that current tax. So income tax, they debit, right? So after they calculate the income tax, so they said income tax, right? So income tax, they debit, and then they're gonna credit the tax, so SARS tax liability, right? This is the first entry they're gonna do. Ne? This is the first one that they're gonna do because that's the normal tax that they get from SARS. Current tax is the normal tax from SARS, right? Using SARS rules, right? That's where deferred tax starts, right? Then you're gonna have this amount that SARS value calculated according to SARS rules, and then what happens is deferred tax. Now you wanna take this current tax amount and you wanna change it into an you wanna change it into an accounting tax amount, and this is the new term. So this is a new term. So this is an accounting tax amount, and this amount basically you find it in the statement of profit or loss. I'm talking about that tax that you find in the statement of profit or loss. So the accounting tax expense, the accounting tax expense, right? So deferred tax, the reason why we do it, is to get from that current tax expense to this accounting tax expense in the P&L, right? So this movement here, this is deferred tax, right? Deferred tax, we do it for this movement, really, right? We do it for this movement, right? And if we're doing it for this movement, do you see that the perspective that we are initially given, like in school, that deferred tax is looked at from a perspective of the accounting side is wrong, because deferred tax is actually looked at from the point of the tax side. However, your calculation should be more accounting orientated. You'll see what I mean as we move on. Now, do you see that from current tax to accounting tax, this is deferred tax, right? However, from current tax to accounting tax, so to get this accounting tax expense, right? You not only have the basically you don't only have deferred tax here, but you also have things called permanent differences, and I will show you where this all ties in. Permanent. So these are the permanent differences that you have, right? So I'll explain again what this thing is. Do you know? So firstly, you know that with the current tax amount, this tax that you calculate here, right? If you were to compare it with the profit, right? So if you compare it with the profit, so if you were to say that current tax divided by your normal profit, right? So your normal profit after tax, so your normal profit. So normal profit after tax is net profit, right? So your normal net profit, right? Then you know that, yeah, then you say multiplied by 100, right? You know that the percentage that you're gonna get here, right, is not the 28% that you are used to, right? Because why? They are gonna use tax rules, right? And tax rules will definitely not give you this accounting amount. It will give you another percentage because it doesn't use the same basis, right? So it won't give you this amount, right? And the reason why we are doing deferred tax is to get to this 28%. Why? Because the accounting tax. So if you say accounting tax over net profit, right? If you say accounting tax over net profit, that should give you the tax rate, right? That should give you the tax rate. If you do this multiplied by 100%, this should give you the tax rate of 28%, right? This should give you the tax rate of 28%, right? And then if this does not give you a tax rate of 28%, if this it does not give you a tax rate of 28%, right? The reason why, okay, this 28% tax rate is the statutory tax rate, right? You know that currently the company's rate, I think it was reduced to 27%. I'm just using this 28 because 28 is used, still used widely in our question papers, right? So that's 28%. This 28% is the statutory rate, right? So it has to give you 28%. Now, what happens is if this thing does not give you 28%, then you know that there are permanent differences. That's the whole gist of deferred tax. If this thing does not give you 28%, then you know that there are permanent differences. And that's the reason why we do the tax rate recon, to show you why this thing is not 28%. So it's not the statutory rate, right? Why is it higher or why is it lower than the statutory rate? Is because of the permanent differences. That's why we don't get to that amount, right? So now that we've covered basically the basics of deferred tax, I'll show you how to actually do it using this. So basically this perspective, right? How to do it using this perspective. Don't forget, we are going from current tax amount to accounting tax amount. That's why we do deferred tax. So the first thing is okay, the method, that's the best for deferred tax. For me, it's the profit and loss method, right? Although both the profit and loss method and the assets and liabilities method are actually on the same level, the profit and loss method is better because most questions of deferred tax will ask you deferred tax movements, right? So what's the deferred tax for this year, right? If they ask you the balance, then I suggest you use the assets and liabilities method. However, I'll show you how to use the assets and liabilities method and the profit and loss method using our perspective. However, the way you write it in the test, please write it the way you are taught, because you will not get the marks that like they're supposed to give you. Although you're gonna get the same answer, you're not gonna get the marks that you are supposed to get. So let's move on with this. So let's start with the profit or loss method. Profit or loss method. So profit or loss method, and let me show you how you do it. So for the profit and loss method, you don't need to start with that accounting tax and no. We're just gonna look at the movements. You don't need to look at the accounting profit and what profit. So let's start. Let's say we have here an asset. Let's say we have an asset here, PPE. Let's say we have PPE here, and this particular equipment, let's say it costs us 100,000. And then on this equipment we've got depreciation of 10%. So that's depreciation. That's depreciation. Depreciation. right? And 20%, let's say it's wear and tear. So 20%, let's not say wear and tear, let's just say you got the section 12C for this. Let's say this was just manufacturing equipment. So you've got this and it's second hand. So you've got this 20%, right? Now, for this 100,000, right? The first thing you're going to do, if it's depreciation, right? If it's depreciation, so do you see that depreciation here? Okay, let me use a better example. I'll just use wear and tear here. Wear and tear. However, even with that section 12C, was going to work the same. So the first thing you determine here, you start here, right? You're gonna start here. So let's say they say calculate the deferred tax movement for this year, right? Using the profit or loss method, right? Now I'm gonna use my perspective first, and then I'm gonna show you how you should answer it like in a test using their perspective, right? But mine, at least you can use if you're confused whether or not in terms of like the deferred tax amount, you can just use my method to check yourself quickly. So the first thing you do is I gotta we start from the text perspective, right? Like I said, deferred tax is from the text perspective first. So you're gonna start with the text perspective, right? And then you're gonna ask yourself this question. This question is very fundamental. Ne? That amount. So you're gonna ask yourself in text, like in text, what did they do, right? The first thing you know that in text they had a wear and tear of 20%. So they had a wear and tear of 20,000. So in text, what did they do? They said what minus 20,000, right? So when you're doing this, you are going to firstly ask yourself this one question: that 20,000, that amount, is is it a temporary or is it a permanent difference? Now, every time these amounts will always be differences. It doesn't matter. These differences will either be um, temporary or permanent, right? Temporary or permanent, but that's what you ask. So this wear and tear, you know that is different from depreciation, right? So this difference of wear and tear, is it permanent or is it temporary? That's the main question you have to ask yourself, because that's deferred tax. Deferred tax is tax on temporary differences, not permanent differences. So you do not consider permanent differences when you're doing deferred tax. So for in this case, wear and tear, do you see that wear and tear is a temporary difference? Why is it a temporary difference? Because at the end, accounting is going to depreciate that entire 100,000, and tax is also going to depreciate that entire 100,000, but tax is going to depreciate it faster than accounting. Do you see? Right? And we say what? We say we are going from current tax to accounting tax. And what does that in essence mean? It means that we are saying that tax is the one that's wrong and accounting is the one that's right. I'll show you what I mean here. So now that we know that thing is a temporary difference, we know that when it is a temporary difference, we know that we can include it here. If it's not a temporary difference, you do not include anything here in this calculation. So I'll show you what I mean. But when I give you another example, so this is the 20,000 firstly for the wear and tear, right? Tax is wrong, so we add it back. We have to add it back this wear and tear, and then depreciation is 10,000, right? Depreciation is 10,000, and this was what was supposed to be. And this, okay, the first thing, okay, before we start 10,000, the first question you asked firstly, like as usual, is this a temporary or a permanent difference, this 10,000? And you know that is a temporary difference because it's going to be the same as the wear and tear. So we are okay with that. Now that we have all of this, we can aggregate it, and the amount we get in aggregation is 10,000, right? Positive 10,000, right? So what does this mean? What does this mean, right? This means that we have to have had an additional inclusion of 10,000, right? Do you see? This is what it means. We must account for an additional inclusion of 10,000 according to accounting, right? This is what we have to do. Account for an additional an additional inclusion of 10,000, right? And do you see that it is positive because it is an inclusion, right? So this inclusion, do you see that this inclusion, what is an inclusion? An inclusion increases your tax expense, right? It increases your tax expense. So what does it mean? It says that we have to increase the tax that we are paying this year. So what are we going to do? You're going to say income tax, we debit, right, with 10,000 times 28%, because you have to multiply 28% here for it. So we're just going to say multiply 28%, that's 2,800, right? So we're going to say income tax, we debit with 2,800, right? 2,800. Do you see that income tax amount is going to increase? And that income tax amount is this accounting tax amount. Do you see? Because we firstly started by doing this, and this is the current tax. Then we said debit 2.8 income tax, and then credit what? Now, don't forget, we are liable for that tax, right? Because we have to pay them. It is an inclusion. We according to accounting, we have to pay more tax this year, right? So it's a deferred tax liability because we are liable for that tax, right? So we're gonna debit income tax and credit deferred tax liability, right? Yeah, that's the whole gist of it. And I'll show you another way, like to show you that this also works. Let's say you have something like let me give you an example, a provision, maybe, for instance, right? You know that for most provisions, tax will give you that provision when like during payment, right? When it actually happens, right? But accounting accounts for it now, right? Accounting accounts for it now, right? So let's say it's a provision. It's a provision of 150. So for tax purposes, what's going to happen for tax purposes? Nothing happened for tax, right? We agree. Tax didn't do anything with that amount. So for tax purposes, for that tax part, you won't do anything first, right? However, for accounting, let's say the provision was 150,000. We have a provision of 150,000. So we know that we have this expense of 150,000 that we have to record according to accounting. And we said accounting is right. Ne? And we know that when you raise a provision is an expense, and expense is a minus, right? So what happens is at the end, we are gonna have, okay, firstly, you're gonna have this zero from the tax side. So that means that our total is going to be still this 150, right? Now, do you see this 150 is a minus? And what is a minus according to tax? A minus is a deduction, right? And a deduction is a positive thing for us, right? The company taxpayer, right? Because it's positive, we are entitled to that. We are saying we're entitled to that tax. So because we are entitled to that tax, is the deferred tax asset. So deferred tax, we are going to debit and we are going to credit the income tax. Do you see when we credit income tax, this current tax amount is going to decrease, right? But still it's going to come to this 28%, which means this current tax, like, it gave us a higher amount. So sometimes this current tax gives you a higher percentage or a lower percentage. And then this deferred tax amount just corrects it so that it becomes this 28%, right? I will give you a more extensive video of like with deferred tax. Honestly, a video is not really gonna cover it. We need like a real session where we have like a lot of examples. But this is just to help you basically with subs, like on the corner, on the side, just do this, right? So this, you're going to say deferred tax asset, you debit and then you credit the income tax, right, with 150 multiplied by 28%. So that's how you do it from a profit and loss perspective. Ne? And normally when they say do it from a profit and loss perspective, what do? They said the tax amount is correct, right? So the tax amount is supposed to be a minus. So do you see that with the profit and loss amount, you can start doing it with my method and then just change all the signs when you're done. Ne? That's what you can do with it, because the method that I use is basically the the logical method for deferred tax, because deferred tax is actually from the from the tax perspective to accounting perspective, not accounting perspective to tax perspective. Ne? And I'll also show you why this also works like with the assets and liabilities method. This works even better for the assets and liabilities method. Ne? Let me show you how exactly. Oh yeah, last example. Yeah, this is a very important example. So this one I have to also do it. So let's say you have this okay, firstly let's use amounts. So let's say you have this investment property, and this investment property costs around 250,000. Costs around 250,000. Tax says, in tax terms, tax says, nah, this is normal commercial building, so I'll give you a 5% allowance on this building. However, for accounting sakes, it will use the fair value model, right? And let's say this year there was a fair value. Okay, I don't, yeah, let's use loss, for instance. So for gain or loss, it's the same thing. The reason why I want to use loss is because in most cases they use the gain. So I want to use loss this time. So let's say we have a fair value loss of, let's say, something like 50,000 this year, right? So let's firstly use the profit and loss method again, like the way I told you, right? So the first thing is you have to check what the text do, right? So text, what the text do? Text, it just took this 250,000, right, and multiplied it by 5% because this allowance is unapportioned. 250,000 multiplied by 5%, and it got this 100 and so 12,500, right? So you remember tax initially, what did it do? It subtracted that amount, right? When it did the current tax, it subtracted that amount, right? So we're gonna add it back. But don't forget, when you're showing them, like when you're doing it on the paper, this amount has to be a negative. So these amounts have to change. However, the logic is still the same. So you can use either their logic or mine logic. But I think this one is better because it actually explains deferred tax. Yeah. Especially for those who are doing BX third year. Knowing it this way will really help you because deferred tax is everywhere. I mean everywhere. It doesn't end. Even in honors, it's still there and it's still a problem. So if you can fix it now, at least you know that for accounting purposes, even in honors, you already have your 30%, right, for accounting, because deferred tax, you always have to consider it for every transaction. Don't also forget that. So it's going to be that, and for accounting purposes, right, you're going to have what a normal loss. It's just this loss, right? Because there's no depreciation for this one. So it's just this loss. Now, like I said, we forgot the first step before we put this amount. I said before we put this amount, the first thing we have to ask is that amount, that 12,500, is that amount a permanent or a temporary difference, right? That's very important. Is that amount a permanent or temporary difference? And do you see that that particular amount, that 12,500, it's actually a permanent difference? And I'll explain why it's a permanent difference. Like you see with deferred tax, you really have to think deep. So the reason why this thing is a permanent difference, this 5% allowance, think about it properly. What how do you determine whether something is a permanent difference or a temporary difference? You're gonna look at the accounting side and the tax side. So you're gonna firstly check with this allowance. We are receiving a 5% allowance, right? An allowance is it behaves like depreciation, right? So you are depreciating the cost when you are busy doing the allowance, right? And do you see that in accounting we are using the fair value model, right? Do you see that using the fair value model will never discount this amount, right? So tax and accounting will never, these amounts will never be the same, right? Therefore, there is a permanent difference there. There is a permanent difference. And that 12,000, that 12,500, that 12,500 for tax purposes, because it's a permanent difference, you will not have anything here. So that 12,500 will not appear on the profit or loss side because it's a permanent difference. Like I said, deferred tax is for temporary differences. So it won't be there. So for tax purposes, it's just nothing there for deferred tax purposes, right? So that's for the tax side. And then for accounting side, when I look at this fair value of fair value loss of 50,000, right? Now, what do we know? Tax is only gonna realize this fair value loss, right, when you actually selling the asset, right? It's going to realize it when you're actually selling the asset through what? CGT, right? That capital loss, right? It's going to realize it when you are, so it's going to, so tax is going to realize it when you actually sell that item, right? So there is some sort of temporary difference there because it is going to realize it, but how much is it going to realize? Only 80%, right? It's only 80%. That's how much it's going to realize. So do you see that the temporary part, the temporary difference part, it's on the 80%, not the 20%. The 20% is permanent. Tax will never reach that amount there. Do you see? So which means for accounting, we said accounting is right. So we have to put this 50,000, right? However, we said when you're doing this, we're only putting only temporary differences. So don't forget to multiply this by, don't forget to multiply this by 80%, right? And the amount you get here is a temporary difference. So the temporary difference here is that 50,000 multiplied by 80%, and that gives you the 40,000, right? That the minus 40,000. So that gives us that minus 40,000, right? That's the temporary difference. Do you see? Then we're going to say that that 0 minus the 40,000, and at the end we get still the minus 40,000, right? This is a deduction. A deduction is positive for us. It's a deferred tax asset, right? So we're gonna say deferred tax asset you debit, and then income tax you credit, right? Let's do it using the assets and liabilities method, and let me show you that this thing is still gonna give us the same thing if you use the logic that I gave you. So we have your current tax, we have your tax base here, right? Right? For current tax, we have our tax base here, right? So let's firstly start with this example, and I'll move on to this one, right? I'll move on to this one when I'm done. So don't forget that these things are temporary differences. Ne? So when you account for them in your journal entries, don't forget to multiply it by the statutory rate. So the 28% or 27% if they say 27%. So I'm just using 28% because the statutory rate. Don't forget it's the statutory rate. Now this 28% is the statutory rate. So the rate yeah, they'll just tell you what rate it is. Then let's go on here. So the carrying amount here, right? We agree is going to be 90,000, right? So the carrying amount here is going to be 90,000. We agree. I'm using this first example, the PPE example. Ne? Then the tax base here is going to be 80,000, right? That's the tax base. And then we have here the temporary difference, right? Temporary difference column. And the temporary difference here is going to be positive 10,000, right? It's going to be, let me just do this, positive 10,000, right? Now let's explain. Let's get into the gist of this, right? So even with the assets and liabilities method, you can also explain this, right? You can also explain this, right? Because what happened here, account tax realized a deduction of 20,000, right? My accounting says tax is wrong. Tax was supposed to actually realize a deduction of how much? 10,000, not 20,000. Do you see? But tax realized a deduction of 20,000. So do you see that tax deducted more than it should have, right? And if you deduct more than you should have, it means that we are shorting an inclusion of this. So we have to have an inclusion of 10,000, right? You deducted more with 10,000, right? And this amount is still temporary, right? It's still temporary. Do you see that tax deducted more than accounting? And we said accounting is the one that's right. So do you see that now we are liable for more, right? We are liable for more because we are supposed to deduct less, not more. So we are supposed to deduct 10,000, not 20,000, but we actually deducted 20,000. So that means that our tax expense, current tax expense, is actually lower than it's supposed to be, right? So what we have to do is we have to increase that tax by saying income tax we debit, and then we are going to credit the deferred tax liability because we are liable for the tax. So do you see the same principle still works here? Same thing, and then you're going to get the same amount. It's just that with the assets and liabilities method, you're going to get the balance. And then this question, like I said, deferred tax it's better if we do it like for an entire lesson, because I have to show you also how the difference between the profit and loss method and the assets and liabilities method. However, for now, I'm just going to show you the parts that I think will help you with the sub. Ne? But the class straight, we're still gonna go through the deferred tax class. Yeah, just after the sub. So, okay, that's the PPE part. Ne? Do you see that the PPE part, we still get the same answer using the same logic? And then we come to investment property. Ne? So for investment property, for the assets and liabilities part, ne, right, we start with the carrying amount, right? Now, I'm telling you now, ne, if that amount, that asset, ne, that asset, like it's a tangible asset like this, ne? So, okay, even if it's not a tangible asset, so even if it's a financial asset, so if it's an asset, nah, Mara, it has to be a tangible asset. Now, Mara, even if it's a financial asset, yeah, it will work even if it's a financial asset. The thing is, I'm thinking on your level whether they want to ask financial assets. Yeah, they are going to ask financial assets. So if so this is when you're doing the assets and liabilities method. So the first thing you're gonna do when you're calculating the carrying amount of the asset, the first thing you're gonna do in calculating the carrying amount of the asset, before you put in that amount there, you do calculate the carrying amount using accounting terms. The first thing you have to ask is whether that amount is depreciable now. That's very important. So even if it's so when I say depreciable, like think of one thing. Subsequently, as you are using this asset, like does the value of the asset decrease on the statement of profit and loss, right? Like for instance, even if it's not a financial it's not a it's not a tangible asset. So even if it's a financial asset, and when I mean things like maybe you have shares, maybe you see that shares like are not, they don't really depreciate, right? They're just the value of those shares is just there. You have shares in another company, the value of those shares is just there, right? Do you see that amount like it's not depreciable, right? It's just fair value estimates that change that amount. So if it's just fair value estimates that change that amount, it's very important to isolate the cost of that amount and the gains, right? So if it's not an amount that reduces over time, right? It reduces just because maybe of certain conditions, certain market conditions, then you have to firstly write the cost of that asset first as the carrying amount. That's very important. So that is very important. Look at that thing. So whether it's an asset or like look at it, look at its nature, right? You're gonna put in that full amount there. If it like through time it doesn't decrease, right? If it doesn't decrease with time. So do you see that with investment property, this investment property does not decrease with time? Do you see? Or increase with time? So it has to decrease with time or like increase with time, not just market conditions. So what this, so you're gonna start with the cost of 250,000, like I said, if that's the case, right? and then right underneath this amount, then you're going to have the gain or the loss. So if it was a gain, you're just going to have a 50,000, maybe 50,000 gain, but this time it's a loss of 50,000 loss here. I'm going to put it like this, right? This is how you do it. And then on the tax side, you're going to check the tax base of this asset, and we see that the tax base of this asset, right? The tax base of this asset, right, is what? The tax base of this asset is what? Is 250,000, right? So 250 multiplied by 5%, that gives us 12,500. If you say 250,000 minus 12,500, that gives us so that gives us an amount of 237,500, right? Right. So that's the tax base, right? Now, do you see that this tax base, this thing is depreciation in nature, right? So do you see that? Why did I put a ish? Let me minus this ish. Yeah, I just had to put in that. Sorry. Let me just put back the 250,000, and here it's not a minus, it's just it's a 237,500. Yeah, that's the tax base, right? So that's the tax base. That's what we expect from tax, right? Now, do you see that this amount and this amount will never coincide, right? These two amounts will never, they'll never be the same, right? So what I'm saying is, when you have this cost, this element, so if you have this element like this cost element in an asset, if you have this cost element in an asset, then for this cost element, there will always be a permanent difference for this entire amount. That's why here they write IRE. You write IRE because for this one, for that initial part, initial recognition exemption, that initial recognition, it's always exempted, because if obviously there's a permanent difference between the accounting side and tax side, right? That means that this thing you won't have temporary differences for them. So they are permanent in nature. This thing will never coincide, right? They'll never be the same. So that's how you do that one. And then we move on to this 50,000. Now, this 50,000, we know that the tax base for this 50,000 currently is nothing, right? We don't have anything here, right? For the tax base, right? We don't have anything here, right? Then that will give us like 50,000, right? Minus 50,000. So it's minus that 50,000. That's the temporary difference that we are gonna get here. Minus that 50,000. Let me just type it back here. So it's 50,000, right? And here we also have the 50,000. I'm sorry, this is, let me just try to expand this. Okay. Okay. Let me put back this thing. Okay. Oh. Okay. So here it's going to be 50,000, right? That's the temporary difference. Nah, yeah, that's the temporary difference, right? So what do we also know about this amount? Will tax ever get to this 50,000? It won't get to this 50,000 straight, like I said. Tax will only get to what, an 80% of that amount, because it's only temporary until you sell this asset, right? This difference is only temporary until you sell this asset, but the temporary part is only the 80% part, right? Because tax is going to realize a capital gain of 80% at the end of the year, right? You are realizing the gain now, right? And I said accounting is right, right? This thing obviously it's a loss. I mean, it's a loss. So this loss, you have to record it when accounting says now you have a loss of 50,000. Tax says now you're going to record it at the end when you're selling the asset, right? And I said between accounting and tax, who's right? The one who's right is accounting, right? So according to tax didn't deduct anything this year, right? Accounting said you had to deduct 50,000. However, don't forget, deferred tax, we are only accounting for the temporary part for it. So the temporary part of this 50,000 is 50,000 times 80%, which is 40,000, right? That's the temporary part of it. And we know that according to accounting, we should have had a deduction of that of 40,000. Do you see? And if we are entitled to a deduction is a positive thing, right? So we are going to say deferred tax asset we debit, and then we're gonna credit the income tax with what, 40,000 multiplied by 28%, which is that 100 and so I mean 11,200. Yeah, that's how you do deferred tax. So yeah, try out this method and then tell me if it works. I hope that was helpful. And yeah, good luck. Good luck with your supplementaries. Thank you.